With stocks mostly range-bound and heading into a challenging seasonal stretch, what is the best strategy right now for investors? Saira Malik is head of Nuveen Equities and Fixed Income, CIO and chair of Nuveen's Investment Committee, joins us now. It's nice to see you.
Good to see you, Scott.
So we have an undeniable pause. Is it just that? Do we need to reverse ourselves lower, or where do we go from here and why?
Well, Scott, we are leading to low liquidity in late August. And as you mentioned, September is traditionally the worst month of the year for the S&P 500. I think there's three other factors impacting the markets, and that's earnings, which overall, while they've been strong, we've seen some mixed single stock earnings, employment markets, and of course, drama over the Fed. So starting with earnings, while we expect earnings, when all is said and done, to grow about over 10% year over year, which will be about double what consensus was coming in, the leaders of earnings are tech, and tech earnings have been more mixed. Finally, we got the payrolls data for last month, which was weak at around 73,000 payrolls. ISM data has been weak, so we're concerned about the economy. And of course, the Fed drama about who will be the next Fed chair is making the markets a little bit nervous.
What's the message, do you think, in the fact that, yes, we've had a chop, and it's the NASDAQ which has been weathering that choppiness a little better than the others? Is it a sign that you as an investor want to just stay with the tried and true AI hyperscalers? Because trying to go elsewhere is just going to be too difficult if we're going to have a more turbulent August and then certainly September.
Well, the drivers of the NASDAQ would be threefold. One is that AI trend that should remain in place. Second is the 10-year yield, which on treasuries, which has been moderating, which is positive for technology stocks. And if you are worried about the economy slowing, that's usually positive for strong structural growers with their own levers to pull, and that's tech stocks. So I think the NASDAQ is the place to be. The AI boom is alive and well. Within the choppiness we've seen with tech earnings, the main theme has been continued tens or even 100 billion plus investments in billions in AI and how that can increase productivity and revenue growth going forward.
Do you think rates are going to continue to move lower?
That'll be the potential catalyst in September. Given where employment came in last month, if we see another weak print for August payrolls, I think that would seal this deal for a 25 basis point rate cut. And I think 50 should be brought back onto the table. We may even see that. As for the 10-year, as long as the economy is showing signs of slowing, I think that leads 10-year treasuries to drift a little bit lower, but not so much lower. Our view is a range of about 4 to 4.5% is the right range for the 10-year for the rest of this year.
What justifies a 50 basis point move? I mean, I hear you on the revisions of the jobs numbers, but the economy still looks pretty good to many watchers of it.
If you go back to September 2024, which is when we got that 50 basis point rate cut, it came after 3 months of sub-triple digit returns in terms of payroll print. And so we are almost at that point right now. And remember, the economy was strong back then also. So you could see a 50 basis point rate cut come back onto the table. The Fed has stated that they're watching the employment markets very closely. The other side of the coin, of course, is what does it mean for inflation? And that's going to be the Fed's conundrum. How do these tariffs impact inflation going forward? We've not seen a tariff bump on inflation yet, but that could be to come. So that's where the Fed balances. Our base case is 25 basis points for September, unless we see something much more dire with August payrolls later this month.
But do you think we're going to have a pickup in inflation beyond what some are suggesting could be just a one-time thing?
I think that likely it's a one-time bump in terms of how tariffs impact inflation, and the Fed has said that they will look through that one-time bump. If you look at core inflation beyond any impact of tariffs, which we haven't really seen yet, inflation has been trending towards the Fed's target, and that's the good news. So I think inflation is in a good spot, but we probably will see a one-time bump due to tariffs and then move on from there.
What's your favorite part of the market right now?
Well, we like infrastructure. I mean, all we hear more and more about is more investment in the U.S. Infrastructure on public and private side has been a call for our Global Investment Committee for many quarters now. I think investing in America is going to lead to much more infrastructure, AI data centers, upgrading our electrical grids in order to be able to fund all of these new investments and building the necessity-based infrastructure in the U.S. All of that is a multi-year tailwind for infrastructure. I mentioned we also do like artificial intelligence trades because that is going to be a structural growth theme going forward where companies continue to invest.
I mean, when you talk about infrastructure and dividend-paying stocks and dividend growers, are we talking about power players in AI? utilities and things like that, which appear to be, frankly, the new growth stocks, not the, boring staples that they've been for decades.
Well, the segments behind infrastructure tend to be utilities, waste management, and midstream pipelines. I think utilities are a strong play for infrastructure going forward. They're going to be needed in order to fund the electricity that's needed as we use more and more AI. We're going to need to upgrade our grids as we shift more to using renewable energy. That's going to be a key sector going forward, and that's a big part of the infrastructure play.